Claims that the European Union's shaving of bank deposits in Cyprus will save the Mediterranean island's shattered economy are hollow indeed. It's Cyprus that's been hollowed out. But that's not the end of it. Eurozone investors wonder who's next. And isn't it time to pull money out of the continent's weaker banks? Welcome to Agenda with me, Colin Chapman, and Stratfor founder George Friedman. George, let's be clear. This deal keeps Cyprus in the Eurozone, but at huge cost to the people.
Certainly it hasn't saved all of Cyprus's banks. Certainly it hasn't saved all the depositors. And certainly it hasn't stabilized the Cypriot economy. What it has done is allow the European Union to claim that it solved the problem without actually specifying what problem it actually saved. Cyprus is now facing a profound crisis. The banks have certainly been told that the deposits under 100,000 euros would be protected. But frankly, if you're a company in Cyprus, and remember, this is the local banks for Cyprus, not only places where Russians deposit money, if you own property in Cyprus, such as hotels, which are a major industry in Cyprus, you have substantially more than $100,000 on deposit. With that money, you have to do payroll. With that money, you have to pay suppliers. You have to pay taxes. There are many things you have to pay. And the problem right now is that not only is a portion of that amount, above $100,000, going to be taken by the state, but also, and this is extremely important to understand, the time frame in which those deposits will become available is unclear. And that means there are people in Cyprus who are not going to be paid. They're not going to be able to pay their mortgages. They're not going to be able to pay their rent. They may not be able to buy their food. We have created a solution which inside of Cyprus is an absolute catastrophe. And I think the most significant thing about the European Union is that now it clearly doesn't care. There was a period a few years ago when the European Union had as one of its goals softening the blow. Well, that's gone by the wayside in Spain and Greece with extraordinarily high unemployment rates. But now, in the case of Cyprus, it really doesn't seem even to be a matter. And somehow the European Union and its officials are regarding the Cypriots as illegitimate members of the European Union, as inappropriate to be there. They shouldn't have been in there in the first place, which I think is altogether true, but it has to be remembered that the European Union allowed them to join. Under whatever circumstances, we're busily expanding the Union, and now we're taking no responsibility whatsoever for the citizens of Cyprus, which is going to resonate throughout the Union.
Cyprus has been crushed, but it's wider than that, isn't it? Because with exchange controls, there's no single currency. A euro in a Cyprus bank is now worth less than a euro anywhere else. A currency union with currency controls just can't be a currency union.
Well, this is what's particularly interesting. One of the principles, a founding principle, was the mobility of capital, that you can move money from one country to another at will, as you can move people from one country to another at will, as you can move goods at will across the borders. In the case of Cyprus, they have now established that that isn't the case. In the case of Cyprus, the money does not any longer flow freely across borders. And they're setting a precedent. They're setting a precedent, in this case, for what the European Union can impose on Cyprus and what Cyprus is allowed to do in concert with the European Union. But I think other countries, such as Spain, such as Greece, such as Italy, will be asking the question, well, if Cyprus can control the amount of currency flowing out, can we control the amount of goods flowing in? The free trade zone, which is far more important to Europe than the euro, the free trade zone, which is the foundation of the entire EU enterprise. That itself is now at risk because the principle has been introduced that no capital cannot flow freely. Therefore, in the case of Cyprus, no goods cannot flow into Cyprus freely. And where does that end? Everybody's saying, well, Cyprus is a special case. For years now, we've been hearing in the European Union, everything is a special case. At a certain point, the special case becomes very normal.
Yes. Now, let's go back to what you called the precedent. Others have labelled this a template, forcing better-off depositors to take a haircut. The head of the Eurozone finance ministers latched onto this, saying it meant it would now allow them to go after private money to fund bailouts. Very quickly, European Central Bank members then dived in to say this would not be a model for the future. And then an EU official contradicted this. Confusion all round.
Well, the problem is not that the European officials are contradicting each other. They've been contradicting each other for several years. The problem is that they really are running out of options. Even Germany, with all of its wealth, cannot bail out all of Europe's banks. Many of these banks have deteriorated under stress tests that weren't very stressful and regulations that weren't very onerous. And many of these banks are in trouble. It's going to be very difficult to save all of them unless deposits are seized. Now, anyone who is doing business in Europe, has a company in Europe who, for example, is an American, who is looking at all this, who is quite comfortable leaving money for operating expenses in Europe, is now thinking about perhaps it'd be better to keep a minimum amount of money necessary to operate in Europe and have as much of that money outside the reach of the European Union as possible back in the States, because they go transfer in as needed. If that becomes the norm, that is going to be a tremendous weakening of the banks, because there's a great deal of foreign money in European banks that are not there just to be in banks, that are there because people are doing business. And if people become wary of those banks, they could lighten up the amount of deposits they have and cause the very problem the European Union is experiencing in Cyprus. So it really comes down to a question of the confidence in Europe's banks. And what has happened in Cyprus has just dealt a blow to that confidence. And the European Central Bank clearly wants to shore it up.
And it's not just confidence in banks, is it? But confidence in Europe itself. An analysis of country ratings show 5 European nations, including Britain, sliding, while Latin American countries are actually coming up.
Well, again, sovereign debt and the rating agencies are another story that we can talk a long time about. But there's this much that's clear. The European financial system is deteriorating after years of attempting to stabilize the situation. After having declared that it's stable, it is still weakening, and the Cyprus situation has done nothing good for it. What the Europeans regard as a solution is actually a very frightening roadmap for most people. Latin America, on the other hand, has improved remarkably. So the world does not stay the same. While Europe has been weakening, other parts of the world have been strengthening, Latin America among them. And frankly, when you compare the United States and its anemic growth, but still growth, its high unemployment, but still far lower than most of Europe, when you compare the United States and its performance after its old criticism in 2008 with Europe's, there's no question where confidence is higher. Even with a Congress that is irrational and a president that likes to fight with the Congress, the shape of the world is such that what once was, not too long ago, a certainty of the vibrancy and health of the European Union is not only long gone, but is in the process of being buried.
Stratfor founder George Friedman. Thanks for watching Agenda. See you next time.